Hi everyone, I'm Karan and welcome to Karan's Gyan. Today I'll be talking about margins and margins call. In the past few videos I talked about how margins can be used for purposes of leverage, and I explained you the concept of M to M, marked to market. So I'll just give you a small recap. As you remember, initial margin is generally a percentage of the contract value. If the initial margin is 15%, and both the buyer and the seller of the futures contract have to shell out 15% of the contract value. Generally, the formula for initial margin is span margin plus exposure margin. You might have recalled this formula from the previous video where I promised you that I would explain this formula in detail. Before delving into this formula, I would give you a little background into margins. So, what happens is a client deals with the stock exchange through a broker. That means if a client enters into a futures contract, the broker is liable for the client, and the stock exchange is liable for the broker. So, if the client defaults, the broker is responsible for his default because he takes his liability. All right, and if the broker defaults, it's the stock exchange's law. But stock exchange makes sure that it generally doesn't have to pay brokers losses because it has a lot of guidelines and a lot of capital requirements for anyone to get into the brokerage industries. So all these big companies you see that advertise brokerage, they have actually deposited a lot of money as collateral, as guarantees to stock exchange in the event of them defaulting. So, like I said, if the client defaults, it's the broker's obligations. So, the broker set certain rules which are given by the stock exchange for the client. The rules are based upon the margin the client has to pay and the margin the client has to maintain. That's where span and exposure margin come into picture. So, span margin. Span margin is referred to as maintenance margin. So if you have to have at least span margin in your account for you to be able to have that future contract. All right, because if you don't have that span margin, the broker would ask you to either settle the contract or square off the contract, or maybe like pay additional margin that fulfills your span margin. It is a maintenance margin. At least this much margin should be required. If you don't have this much margin, you can receive a penalty from the exchange. That's why a lot of brokers make sure that their clients have at least span margin in their account so that they don't receive a penalty from the exchange. Exchange uses advanced algorithms to calculate span margins on a daily basis. One key input that goes into this algorithm is volatility of the stock. As I have time and time again told you, margins are generally based upon how volatile a stock is. If a stock is really volatile, the span margin is required to be high, right? Next is exposure margin. Exposure margin is basically a cushion for mark to market losses. So exposure margin is an extra margin paid over the span margin, because if tomorrow the futures price decreases, the person might have a client who has that contract, that future contract. He might have a margin that is not fulfilling the requirement of span margin. He might have a margin which is lower than span, and as a result, he can attract a penalty from the exchange. So, in order to avoid that situation, he has to, like have some cushion in order before reaching span margin. So, exposure margin is a margin blocked over and above the span margin to cushion for any MTM losses. MTM is basically M2M, mark to market losses. Exposure margin is specified by the exchange. Both span and exposure margin is specified by the exchange. It can be between 4 to 5% of the contract value. So if span margin is 10%, another 4 to 5% of the contract value, it would be the exposure margin, and their sum would be the initial margin. So for a person to enter into a futures contract, he needs to have both the sum of span margin and the exposure margin. So I'll delve into the last example I gave you about Hindalco futures. So I bought Hindalco futures for the price of 165 rupees. Lot size of Hindalco futures is 2000. So the contract value would come up to be 3.3 lakhs. Span margin according to the exchange is 10% of the contract value, which is 33,000 rupees. Exposure margin is 5% of the contract value, which is 16,500 rupees. So for me to enter into a futures contract, for me in this case I want to buy Hindalco futures. So if I want to buy Hindalco futures, I think Hindalco futures would increase in the in the coming time, and that's why I'm buying Hindalco futures basically. So I'm long on Hindalco futures. So for me to buy Hindalco futures, I need to shell out at least 49,500 rupees, which is the sum of span and exposure for me to get into the trade. Alright, so what do? I buy Hindalco futures. I buy one lot. One lot, that means 2000 shares of Hindalco for Hindalco futures. Okay, I bought it at 165. 165 is the reference price. So contract value is 3.3 lakhs, span is 33,000, exposure is 16.5k, total margin is 49.5k, 49,500. So what happens is that day Hindalco closes at 170 rupees. Now my mark to market is 10,000. 5 is there has been increase in 5 rupees, so 5 into 2000, which is the lot size. So M to M is 10,000. I get 10,000 rupees more and I've got a cash balance of 10,000 rupees. Now M to M is settled. So for day 2, my reference value would be the closing value. It won't be 165 because the difference of 165 and 170 is already accounted for. So I'll go to the reference price of 170. Alright, now the contract value has increased. It is now 3.4 lakh rupees. And as I told you, since span is 10% of contract value, my span margin will also increase. Similarly, my exposure margin will also increase. Alright, so basically my some component of my M2M has gone into my span and exposure margin, which is about 1500 rupees, 1000 rupees extra for span and 500 extra for exposure. Alright, 1500 has gone. Again, the future has rised up by 5 points, 5 rupees. I have got a profit of 10,000 rupees. 10,000 MTM has been credited into my account. Since I paid additional 1500 rupees, like 1000 rupees extra for margin and 500,000 rupees extra for span margin and 500 extra for exposure margin, I'll get 8,500 rupees from the last MTM and 10,000 rupees from day two's MTM. Alright, so I've got 18,500 rupees cash with me. Now, what happens is I'll consider a new reference price. The reference price is 175 because I've already accounted M to M for day two, where market price has changed from 170 to 175. So now 175 is my new reference. The contract value is now 3.5 lakh rupees. Similarly, my span margin and exposure margin both have increased. As a result, my total margin has increased by 1500. Alright, so see this. My total margin has increased by 1500. So in the morning, I like 1500 rupees margin is increased from my cash balance. Alright, so my new cash balance is technically 18,500 minus 1,500. So it should be about 17,000 rupees. Alright, so it should be my new cash balance. Okay, but I faced a loss for that day, a loss of 30,000 rupees because the market has fallen by 15 rupees. The Hindalco has fallen by 15 rupees. Hindalco futures has fallen by 15 rupees. So 15 into 2000, I have a M2M loss for 30k. But I got a cash balance of 17k. 18,500 minus the extra 1500 I put as total margin on day 2, day 3. So my cash balance is 30,000 minus 17,000. So that is my new cash balance. It's minus 13,000 rupees. 30,000, 30K minus 17K. So my new cash balance is 13,000 rupees. Now, like I told you, exposure is the cushion. Exposure margin is the cushion for my losses. So whatever losses I take, it'll be absorbed by the exposure margin. All right. So you see, first what has happened is new reference price is 160 rupees because the M2M has been accounted for on day 3. Reference price is 160 rupees. So hence contract value is now 32, 3.2 lakh, and my span is 32,000. Yeah, my span has decreased to 3,000 rupees because contract value has fallen. Similarly, my exposure margin has fallen to 16,000 rupees. All right. So what exactly has happened here is, since my cash balance, now look at this day 3 tab day 4 tab very carefully, because it can get a little confusing. All right. So what has happened here is 3,000 rupees have technically been added to my cash balance because my span margin has fallen. 3,000 rupees have been added to my cash balance. So technically, I have a loss of only 10,000 rupees because my span margin has been adjusted for rupees 3,000 because the price of the future has fallen. As a result, my cash balance is only 10,000. 13,000 minus 10,000. So my exposure margin would take in the loss. It will take in the loss of 10,000 rupees. Yeah, because as I told you, exposure margin acts as a cushion for any M2M losses. My M2M losses were because of my previous M2M losses. This my cash balance has been completely eroded, and any negative cash balance has been used for the exposure margin. All right, so my exposure margin has taken some of the hit from the cash balance. As a result, I am technically low on my margin. I am supposed to have a higher margin with me, but since my span margin is already satisfied, I'm supposed to have 10% of the CV as my span margin, which is 32,000 rupees. I don't need to, like deposit any money because I'm still in the on the right side of the trade. I still am safe from any calls from the brokerage for me to deposit more money as a margin, right? But something unfortunate happens on that day, and the future price falls further. It falls 5 rupees and it closes at 155 rupees. I faced a 10,000 rupee loss because 5 rupee loss per future, 5 into 2,000, cash balance is 10,000 rupees, negative 10,000 rupees. Okay, now since cash balance is negative 10,000 rupees, it will be accounted for in the exposure margin. Now look at day 5 very carefully. My span margin has fallen from 32,000 rupees to 31,000 rupees, simply because my contract value has fallen from 3.2 lakh rupees to 3.1 lakh rupees, and I told you span margin should be 10% of contract value. Alright, so every day, since the contract value is changing, the margin amount that I should have should also change. Even that should be taken into consideration. As a result, I'll have 1,000 rupees surplus in my cash balance. Alright, so technically I'm minus 9,000 rupees because 10k minus 1k will give me 9,000 rupees. And this loss of 9,000 rupees would be adjusted on my exposure margin. So my exposure margin is minus 1,500 rupees. Now you see my exposure margin has taken a complete hit. It is down 1,500 rupees, and as a result, my cushion is no more there. My cushion is over, and I'm technically in a negative territory because this 1,500 rupees would be adjusted in the span margin. So what do you think happens on the fifth day? You get a margin call. So margin call is basically a call from the broker. He says, "Sir, your future position has taken massive losses. Your exposure margin has taken a complete hit, it is in negative, and your span margin is getting affected. So, sir, you got two choices. You're either required to pay the required span margin, which is 1500 rupees, because 1500 rupees is the loss. So, he would generally say pay about 10,000 rupees because he'll want some extra money in exposure. Still, he needs a bigger cushion. So, he'll say, sir, pay 10,000 rupees or square of the trade. So if you paid 10,000 rupees, your span margin would increase to, I paid 10,000 rupees, my span margin increases to plus 10k, plus 10k plus, 10,000. Okay, which will be about 8,500. So that will be my new exposure margin after I have paid for margin call. Yeah, it'll be 8,500 rupees after I've given a call and I said, okay, I'll pay you 10,000 rupees. So I have significantly gained some exposure, you know, I've gained some exposure and I've got a cushion and my span margin is still intact. However, if I say, look, I think this is a losing trade, I don't want to lose my money in this trade, cancel my trade, square off my position. If I have bought the future, sell my future. If I have sold the future, buy my future. But square off the trade. So my broker would give me cash balance of 31,000 rupees plus minus 1,500. So rupees 29,500 rupees would be put back into my account. Alright, now look at this. I paid 49,500 rupees as an initial margin. However, my trade didn't go as I expected, and I got a margin call. My broker asked me to pay the required margin, which is at least span or square of my trade. I ask him to square off my trade, and he squares off my trade, and he gives me back 29,500 rupees. As a result, my margin, as a result, I have lost about 20,000 rupees if I compare it to the margin I gave. Alright, compare the reference price at which I bought. I bought it at 165 rupees. I sold it at 155 rupees because that's when I squared off the deal. As a result, I have faced a loss of rupees 10 per future and lot size is 2000. So the loss is 20,000 rupees. So it does make a little sense to you, doesn't it? So this is pretty much it about span margin and exposure margin. I know it can be a little hard. So if you don't understand it at once, revisit the part in which I explain this table and I'm sure you'll understand it again. Alright guys, this is it for margins and margins call. We are pretty much done with margins. So if you guys like this video, please press the like button. If you want more such videos, subscribe to my channel, or if you got any more doubts even after revisiting this video, please comment. I'll get back to you as soon as possible. Have a nice day.